Finance is a vast field that deals with the management of money, investment, and assets. It encompasses a range of activity including banking, investing, budgeting, accounting, and risk management. In this article, we will provide an overview of how finance works, covering topics such as financial market, financial instrument, financial institution, and financial decision making. Financial market are where buyer and seller of financial instrument come together to trade assets. There are several types of financial market, including equity markets, where stock and share in publicly traded company are bought and sold. Bond market, where fixed income securities such as government bond and corporate bond are traded. Derivative market, where financial instruments such as option, future, and swaps are traded. Foreign exchange market, where currency are bought and sold. Commodity market, where raw materials such as oil, gold, where wheat are traded. Financial instruments are tradable assets that represent a legal agreement between two parties. They can be classified as debt or equity instrument. Debt instrument represent a loan that is made by an investor to an issuer. Examples include bonds and loans. Equity instrument represent ownership in company. Example include stocks and shares. Financial institutions are entities that provide financial service to customers. They can be classified as bank, non-bank, financial institution, and investment institution. Banks provide a range of financial services such as loan, deposit, and credit cards. Non-bank financial institutions include insurance company, pension fund, mutual fund. Investment institutions include investment bank and hedge fund. Financial decision making involves the process of making decisions about how to allocate resources, including money and investment. It is a crucial aspect of financial and involves several steps. Identify the problem. Identify the financial problem that need to be addressed. Gather information. Collect relevant data about the problem. Analyze the data. Use quantitative and qualitative analysis to interpret the data. Develop option. Create potential solution to the problem. Evaluate option. Assess the process and cons of each option. Make a decision. Choose the best option based on the evaluation. Implement the decision. Put the decision into action. Monitor and evaluate. Assess the success of decision and make adjustment as necessary. Financial statement are formal report that show the financial position of a company or individual. They include balance sheet shows a company assets, liabilities, equity as a specific point in time. Income statement show a company revenue, expenses, and profit or loss over a period of time. Can cash flow statement show the inflow and outflow of cash in company over a period of time. Financial planning involves the process of setting goals, developing a plan to achieve these goals, and monitoring progress toward achieving them. It involves several steps. Identify goal, determine what financial goal need to be achieved, assess current situation, evaluate the current financial situation, develop a plan, create a plan to achieve the goal, implement the plan, put the plan into action, monitor and adjust, track progress toward achieving the goals and make adjustment as necessary. Risk management involves identify, assessing, and mitigate impact financial improvements. It involves several steps. Identify risk, determine potential risk that include negative impact financial performance. Assess risk, evaluate the likelihood and impact of his risk. Mitigate risk, develop strategy to reduce the likelihood and impact of his risk. Monitor and adjust, track the effectiveness of risk mitigation strategy and make adjustment as necessary.